Let us now proceed to the output method. Output methods recognize revenue on the basis of direct measurements of the value to the customer of the goods or services transferred to date relative to the remaining goods or services promised under the contract. There are two examples, which is the survey of performance completed to date and appraisals of results achieved, milestones reached, time elapsed, and units produced or units received. The output method in construction contracts refers to a pricing strategy where the contractor is paid based on the completed work or the final output of the project, rather than on the costs incurred or time spent. The output method is beneficial for projects where clear deliverables can be defined, allowing for more straightforward management of project performance and cost. The difference between the input method is that it is cost-focused, measures resources used, while on the other hand, output method is result-focused, measures completed work or milestone. Cost-to-cost method focuses on incurred costs, providing more flexibility but less incentive for efficiency. On the other hand, output method ties payment to deliverables, encouraging efficiency but placing more risk on the contractor. Let's look at the illustration 1 for output method, survey of work. Information on an ongoing construction contract with a fixed contract price of 1 million is shown below. The cost of construction is 500,000 and the percent complete is 80%. We are to compute for the gross profit for the year. The total contract price is already given, which is 1 million, multiplied by the percentage of completion, which is 80%, also given. That will result to 800,000, which is the revenue to date, less revenue recognized in prior years. It has not been stated in the problem that it has revenue recognized in prior years. Therefore, the 800,000 will be the revenue for the year. Less cost of construction for the year, which is 500,000. That will give you a gross profit for the year of 300,000. The next illustration is the physical proportion of the contract work. In 20X1, ABC Company was subcontracted to construct the first portion of a 94.5 kilometer 4-lane expressway. Construction started in 20X1 and it was expected that the expressway will be open to the public in 3 years' time. Per House resolution, the total contract price for the first portion of the expressway consisting of 41 kilometers is 13 billion. ABC uses the output method based on physical proportion of contract work in estimating the stage of completion of a project. The additional information on the project is shown below. The cost incurred each year, estimated cost to complete, number of kilometers completed. On the right side, it has the solution for the percentage of completion to date. Number of kilometers completed to date will be divided by to the total kilometers to be completed. For 20X1, it results in 25%. For 20X2, it is 80%. Next, for profits, which is below, stated below the percentage of completion to date, total contract price less estimated total contract cost, which will give you expected total profit from construction multiplied by the percentage of completion. That will give you a profit to date less the profit recognized in prior years. So for the 20X1, the expected total profit from construction is 3 billion because 13 billion less 10 billion is 3 billion. Multiply by 25%, that will give you 0.75 billion. It does not have profit recognized in prior years. Therefore, the profit for the year 20X1 is 0.75 billion. For 20X2, the expected total profit from construction is 2.8 billion because 13 billion minus 10.2 billion is 2.8 billion. Multiplied by 80%, that will give you 2.24 billion less the profit recognized in prior year, which is yung profit on 20x1, that is 0.75 billion less. That will give you a profit for the year 20x2 of 1.49 billion. The estimated total contract cost is computed for 2021, 2.3 billion plus 7.7 billion is equal to 10 billion. For 20x2, the estimated total contract cost is 2.3 billion plus 5.5 billion plus 2.4 billion is equal to 10.2 billion. As for the solution for the contract revenue for the year and the cost of construction, it is made possible by workback. So from the profit for the year, which is computed before, we can get the contract revenue for the year and the cost of construction. Let us now proceed to the changes in the measure of progress. As a construction project progresses and circumstances change, the way we measure how much work has been completed is updated to reflect those changes. If there are adjustments to performance obligations like project requirements or expectations, these updates are made using future estimates following the guidelines in PAS 8. PAS 8 provides rules for how to handle changes in accounting policy, updates to estimates, and corrections of mistakes. Essentially, it ensures that any new information is considered to give a more accurate picture of project progress. Reasonable measures of progress. Revenue for performance obligation that is fulfilled over time is recognized only when the progress toward fully satisfying that obligation can be reasonably assessed. This means that if a contractor is working on a long-term project, they can only record revenue as they achieve certain milestones or levels of progress. If the outcome of a performance obligation cannot be reliably measured, revenue is recognized only to the extent of the costs incurred that are anticipated to be recovered. This means that the contractor can only report revenue equal to the costs they have spent so far that they expect to recover later. This accounting approach is commonly referred to as zero profit method. Essentially, in this method, the recognized revenue does not exceed the cost incurred, which means that the contractor does not show any profit until they can confidently measure the project's outcome. This helps avoid overstating revenue when the future is uncertain. In a sample illustration for zero profit method, information on a construction contract with a contract price of 9 million is provided below. It shows the contract cost per year from 20x1, 20x2 to 20x3, and also the estimated cost to complete. However, estimated cost to complete is not measurable in this. Therefore, the solution for the gross profit for the year is revenue less contract cost incurred per year will result to gross profit for the year. So for 20x1, we have no gross profit because the revenue match with the contract cost incurred per year. Therefore, we cannot recognize any revenue. That same goes with 20x2. And for 20x3, we have 2,700,000 less 500,000. That will give you 2,200,000. The journal entries in 20x1 is provided assuming that billings were 50% of the contract price and collections were 90% of the billings. On the right side, you will see the statement of financial position and the statement of profit or loss. onerous contract or expected losses. PAS 11 is the old standard. When it is probable that the total contract costs will exceed total contract revenue, the expected loss is recognized immediately as expense. For PFRS 15, which is the current standard, as soon as a contract becomes onerous, an entity recognizes a provision for the loss it expects to incur on the contract in accordance with PAS 37 provisions, contingent liabilities, and contingent assets. In summary, while both PAS 11 and PFRS 15 deal with onerous contracts and expected losses, PAS 11 recognizes losses immediately, while PFRS 15 takes a more measured approach, recognizing losses at the reporting period's end and focusing on present value estimates of future losses. This represents a shift toward a more comprehensive revenue recognition framework under PFRS 15, aligning it with the overall contract performance assessment. This is the illustration 1 for onerous contract in the book. In 20X1, ABC Company started work on a 1 million fixed price contract. Information on the construction is shown below. Costs incurred to date, estimated costs to complete is given from 20X1 and 20X2. The requirement is to compute for the loss in 20X2. I think this one is very self-explanatory, and the loss for the year 20X2 is 150,000.